Hey, what's up guys? Brad here. So today I want to give a summary of The Most Important Thing Illuminated by Howard Marks. Now, a number of years back, when I was interested in getting started investing in the stock market, I reached out to 20-some equity research analysts on LinkedIn. And I asked them, what are the books that have really influenced you as an equity research analyst? And this book came back as one of the top 5 from, those people's recommendations. And so Howard Marks is the manager of Oaktree. And this book really came out of, years and years of letters that he was writing, annual letters that he was writing to his investors. And, the title, The Most Important Thing, it's kind of a joke because Howard would say, all right, the most important thing is controlling risk. And then, the most important thing is second level thinking. And he would constantly say the most important thing is, and it would always be something different. And, so he came up with 21 most important things. And that's really what this book is all about, laying out those 21 most important things. So let's dive right into it. I want to pull out some of my highlights from each chapter. I'll probably do a handful of chapters in this video, and then, depending on how it goes, we can do some follow-up videos if people are interested. So let's get right into it. The first chapter, the most important thing is second level thinking, okay? And right off the bat here, we've got a quote from Charlie Munger. It's not supposed to be easy. Anyone who finds it easy is stupid. Okay. So what is second level thinking? Well, there's millions of people who are competing to make each, additional dollar of investment gain. There's millions of people in the stock market who are trying to do better than average, okay? Now, the only way to do better than average is to have superior insight, intuition, sense of value, and awareness of psychology. Those are the things that are required for above average results. And doing those things requires second level thinking, okay? So what is first level thinking? First level thinking says, it's a good company, let's buy the stock, right? Second level thinking says, it's a good company, but everyone thinks it's a great company, and it's not a great company. So the stock is overrated and overpriced. Let's sell, okay? First level thinking is simplistic and superficial, and just about everyone can do it, which is a bad sign for anything involving an attempt at superiority, at beating the average. All the first level thinker needs is an opinion about the future. The outlook for the company is favorable, meaning the stock should go up, right? That's first level thinking. Second level thinking is deep, complex, and convoluted. The second level thinker takes a great many things into account. What is the range of likely future outcomes? Which outcome do I think will occur? What is the probability I'm right? What does the consensus think? How do my expectations differ from the consensus? How does the current price for the asset comport with the consensus view of the future and with mine? Is the consensus psychology that's incorporated in the price too bullish or too bearish? What will happen to the asset's price if the consensus turns out to be right? And what if I'm right? So clearly there's a huge difference in workload between first level thinking and second level thinking. And the number of people who are capable of second level thinking is tiny compared to the number of people who are capable of first level thinking. So that's I think, a pretty good overview of what second level thinking is. Here's one more nugget. To achieve superior investment results, you have to hold non-consensus views regarding value, and they have to be accurate. That's not easy. Okay, and that'll come up again in future chapters. So that's kind of an overview of second level thinking. Chapter 2, the most important thing is understanding market efficiency. Okay, so there's this efficient market hypothesis. Now, Marx does not believe in that the market is always efficient. And that's a key point here. He says, I agree that because investors work hard to evaluate every new piece of information, asset prices immediately reflect the consensus view of the information's significance. I do not, however, believe the consensus view is necessarily correct. In January 2000, Yahoo sold at $237 a share. In April 2001, which is 15 months later, it was at $11. Okay, so it was about less than 5% of what it was 15 months earlier. Anyone who argues that the market was right both times has his or her head in the clouds. Okay. The bottom line for me is that although the more efficient markets often misvalue assets, the markets where there's more capital, right? There's more eyeballs on those markets working to take advantage of mispricings. It's not easy for any one person working with the same information as everyone else and subject to the same psychological influences to consistently hold views that are different from the consensus and being closer to correct. So the most important upshot from efficient market hypothesis is its conclusion that you can't beat the market. All right. What else do we want to take away from this one? Right. The theory says that all the available information will be smoothly and efficiently synthesized into prices and acted on whenever price-value discrepancies arise. Discrepancies between price of a stock and value of a stock, so as to drive out those discrepancies. However, human beings are not clinical computing machines. They're driven by greed, fear, envy, and other emotions that render objectivity impossible and open the door for significant mistakes. So, here's another interesting point. For every person who gets a good buy in an inefficient market, someone else sells too cheap. So that's a really important thing to keep in mind, is that there's always two sides of a trade, of a buy and sell order, okay? So the key is to ask yourself the question, are you smarter than the person who's selling you that company or buying that stock from you? That's an interesting thing to keep in mind. I believe strongly that mainstream securities markets can be so efficient that it's largely a waste of time to work at finding winners there. So, he's talking about how, and Joel Greenblatt says this as well, it's important to look in inefficient markets where, typically smaller companies, if you're talking about stocks, where there aren't as many analysts covering them, there aren't these institutional buyers going after them because they're too small. They won't move the needle on the portfolios for these big institutional buyers. We should assume that efficiency will impede our achievement, our search for high returns, unless we have good reason to believe it won't in the present case. So we should assume the market is efficient unless there's compelling evidence to suggest that there's a mistake in this particular corner that we're looking in. The key turning point in my investment management career came when I concluded that because the notion of market efficiency has relevance, I should limit my efforts to relatively inefficient markets where hard work and skill would pay off best. So that's kind of what I just said. All right, let's move on. Chapter 3, the most important thing is value. Okay? For investing to be reliably successful, An accurate estimate of intrinsic value is the indispensable starting point. Without it, any hope for consistent success as an investor is just that, hope. There has to be some objective standard for high and low. As investors, we want to buy low and sell high. But what is low and high? And Marx here is really making the point that low and high are determined by comparison to the asset's intrinsic value. So if we're talking about stock, compared to the intrinsic value of a share of stock. What is that stock actually worth versus what is the market pricing it at? Okay. We want to buy below intrinsic value and sell at a higher price. That's really the key to value investing. So that's a good summary of value, I think. Without accurate estimates of value, you'll be as likely to overpay as you will underpay. There's a lot of people, beginners, who go into the stock market and they buy because the price of something is going up. They think, oh, it must be a great business if the price is going up, right? But that doesn't tell you anything about whether you're getting a good deal or not, what the stock is actually worth, what the value of that share of stock is. So you need a sense of the value in order to do well as an investor. I think that's an incredibly important point that a lot of people miss. Another big point with value is that being correct about something, so say you're correct about the value and you can buy at a price that's significantly below the value. Being correct about something isn't at all synonymous with being proved correct right away. Okay? It can take years for the price of a stock to come up to the value of a stock. All right? This is where patience is incredibly important. The most we can do as value investors is hope. The most we value investors can hope for is to be right about an asset's value and buy when it's available for less. We don't have any control about how quickly the price is going to come up to match the value, and that's where the patience comes in. Right. Number 4, chapter 4, the most important thing is the relationship between price and value. Investment success doesn't come from buying good things. This is incredibly important. It's the most important thing. It doesn't come from buying good things, but rather from buying things well. Okay? The relationship between price and value. It has been demonstrated time and time again that no asset is so good that it can't become a bad investment if bought at too high a price. All right? We all know Amazon is a great company. We all know Google is a great company. But if you buy those, no matter how great they are, if you buy them at too high a price, it's not going to be a good investment. The price is essential to factor in when you're making an investment. That's really the point here. If your estimate of intrinsic value is correct, over time an asset's price should converge with its value. This is really a fundamental point of value investing, is to, if you do your work well, if you value a company well, and the price is significantly below what the value is, you're just waiting. It's a waiting game. You're waiting for the price to come up. You're waiting for the market to agree with you that was a mispricing. And that's the whole game. And it can take years to do that. Mohnish Pabrai, he basically will wait for 3 years. Okay? If the price doesn't come up to match value within 3 years, he basically takes it as, okay, I was wrong and I need to move on. I'm going to sell out of this position and I'm going to find something different, because you can't wait decades, okay? Especially if it's not a compounder, if it's not a great business. you've got to know when to get out, even if the market hasn't agreed with you yet. So I think that's a pretty good, those are some good points here in this chapter. Relationship between price and value. So the next three chapters are about risk. I'm going to save those for the next video if you guys want to see more. But I really do highly recommend, go out, get yourself a copy of this book. The first time I listened to it or consumed it, I listened to it on Audible. And, there was just so much that was in here that I was like, oh, I need to remember that I had to go out and buy a physical copy and just take all kinds of notes. I think like a third of the book is underlined for me. So highly recommended. Let me know in the comments if you want to see some follow-up videos, if you want me to hit some more chapters of this book, and I'm happy to do that. So that's all I got today, guys. Have a great day, stay safe out there, and I'll see you in the next video. Take care.